Mate, thank you. Thank you for having me back. As per the intro, my name's Adrian Floate. I'm the Managing Director of Spenda, ASX code SPX. I suppose today we're going to go a little bit of a journey of who we are and maybe a little bit on who we're not. So Spenda's in the business, if you like, of building and funding resilient digital supply chains. And we do that in partnership with our customers. And I suppose some people would characterize us as a fintech. And we certainly would appreciate that label. But by the same token, we would certainly not characterize ourselves as a buy now, pay later. Next slide, please. Or two slides, as it were. I suppose the interesting thing to understand about ourselves is that we operate a platform that connects to buyer and seller, and probably most importantly, builds on 20 years experience as a supply chain software vendor. And really, probably the key thing to take away about that journey is, as a supply chain software vendor, we got really good at sharing transactions between a buyer and seller, at integrating those transactions into the respective trading partners' financials. And I suppose the automation of the order to cash or procure to pay cycles, which hopefully is jargon that people are a little bit familiar with. But look, in its simplest terms, what it means is that every supply chain starts off with production, and there's a whole bunch of players that get goods to market, and we in our home lives consume those products. And it probably doesn't really matter what those products are. And we've certainly taken that very horizontal approach to our product in that we're really completely market agnostic. Next slide, please. Maybe I'll just give you the old pen nod if that works. So look, as I said before, we've come off 20 years of experience in supply chain software, but the problem with that was always about the glass ceiling that's attached to a software company and its ability to only derive income, if you like, from licensing and implementation fees. So I suppose for us, what we wanted to do and really as a digital journey was be able to monetize if you like, the flow of funds going through our platform. So if you like, instead of saying, Mr. Customer, we're going to charge you $100 a month for our software, we actually start saying, Mr. Customer, here's our software. It's a vending machine for all these kinds of transactions that you can do with your customers and your suppliers. And when you use them, we're going to charge you a percentage of the value of what goes through the pipe. Now, we've made that transformation over the past 2 years. And that really means that we've added payments and lending capabilities that allow us to charge those fees and quite appropriately charge those fees, but probably moreover, allowing us to blend together different kinds of solutions that originate a transaction between a buyer and seller, and then, if you like, solve for a whole bunch of problems that relate to, late payment, lack of resourcing for administration, automation of administration, removal of, if you like, disputes that exist between the buyer and seller. So we've really hit a whole bunch of business problems head on. But probably the best way for me to explain what we do and what the diversification in business model has done for us as an organization is just talk to the next slide, or three, as it were, about, oh, no, sorry, go back. I just meant there's 3 slides on the topic. So this sort of flow describes a value chain, if you like, or a supply chain to market. And it's sort of a microcosm into the announcement we put out around carpet cord. But what it really highlights is our ability to compete all the way up and down the value chain, which allows us to have both flexibility in pricing, but also to really build a genuine partnership with our trading partners, such that we're not really entering what you'd see as being competitive tension, because we're not selling what we would see as being a one-dimensional product stream. So if we start out on the left, out here we've got a customer that wants to in the case of Carpet Court, buy some soft furnishings or some carpet or whatnot. And typically those customers pay by card. So for us, we're able to offer the franchisee within the Carpet Court network both the software to manage their business, so point of sale, service management, etc., as well as the payment services, whether they be terminal-based or more contemporary digital services to capture those payments. So that's sort of putting us competing with, the payments vendors of this world, both in the terminal technologies, etc., as well as point of sale vendors, etc. But then where we move is the step further. So we're able to now turn around and using either our pay statement by link product or our Spenda AP product, offer like an internet banking service that's fully integrated to that retail business's ledger. So when they make a payment, they send a remittance advice. It actually acts as a payment allocation file for the head office, if you like, or the Carpet Court corporate entity that's acting as the primary supplier. So all of a sudden we've shifted from, I'm going to make you a payment like a bill presentment platform or a standard EFT, where there's actually no processing benefit. So I send you a payment, but you still got to reconcile it. You still got to post it. You've got to do all that work. And, we've digitized that stream such that when I make a payment, it hits the ledger of the seller and updates it such that reconciliation is optimized. Disputes are removed, if you like. We construct a virtual ledger between the buyer and seller, as well as move the transactions. So when the seller invoices the customer, we deliver that transaction to their ledger. So we're just eliminating duplication and the whole concept of the debtor-creditor sort of relationship getting out of sequence. So there's our second income stream, where again, we monetize that flow, but then we can value add to that. So really standard terms of trade between a buyer and a seller might be end of month plus 30 days. So the buyer and seller trade for the month, and then at the end of the month, a statement's sent, and then in 30 days' time, that statement's due. Here's where lending kicks in. I'm a supplier. I'd quite like the money sooner. So we can disconnect those, if you like, the debt of the seller it's owed by the buyer from when the buyer actually pays. And all of a sudden we could say to the seller, would you like to get paid on end of month plus one? But then offer the buyer the ability to go, would you like to actually have 60 days to pay? So take the 30 days you normally had and add another 30. And again, we're able to charge a fee for that and blend that in with all the same reconciliation benefits and collaboration benefits between the two businesses, but most importantly, providing liquidity where it's needed. So breaking the nexus of traditional banking and offering a service that not only optimizes the behavior of the human beings, but it connects those businesses together more closely and provides liquidity to the supply chain. So again, there's our next revenue line. And then finally, if we look out, and now we're operating as the corporate business and we want to now pay our suppliers, again, we can provide that payment framework with exactly the same product that the franchisee might use, but allowing that corporate entity to push payments out to their suppliers. Now, this is where things start to get even more interesting because our business is a platform. It's built on invitations. Every time we send a transaction, whether it's a request to pay, a remittance advice, or just a straight invitation, we're always connecting the next part of the business. So our opportunity from, if you like, this node spoke strategy where we've won a relationship with Carpet Court is to then extend those relationships up and down that supply chain and do more for all of those businesses. Now, in our most recent announcement, we obviously announced that this had a minimum transaction fee income to us of 50 to 70 grand. But it's important to note that only related to the first part of the flow, just that payment going between the store and the head office. It had nothing to do with anything else I just mentioned. So nothing to do with payments from the consumer, nothing to do with extended lending for the store, and nothing to do with supplier payments or otherwise. Now, what we would expect is that those income streams in and of themselves are all in differing stages of implementation right now. We'll continue to accelerate the opportunity and actually put the metrics in the market that show, unlike competitors in payment or competitors in lending or competitors in SaaS, we're able to create this unique recipe that allows us to deliver a compelling ROI to our customer, but also squeeze far more revenue out of that payment flow than anyone else that I'm presently aware of. Next slide, please. So obviously there's value everywhere. So for the end consumer, we're providing payment flexibility. We're giving them the ability to pay cards without needing to present them, but without also having to, read them out over the phone or use IVR services. So we're adding convenience and flexibility, as well as the ability to administer when, you might want to pay, like control the direct debit, which is a really novel concept in our auto pay feature. For the franchisee, we're giving them, if you like, the ability to earn discounts from their supply line with early payment, but also, if you like, access lending and optimize their reconciliation or administration resources who are, in the business of processing payments within that business. We do exactly the same thing for the franchisor, but because we're able to build resilience into that whole network, a big part of our mission is to make that franchise business even more attractive to new franchisees. So we grow together. And then finally, down to the supply line, we're providing that liquidity, we're providing that reconciliation benefit. So we're delivering those benefits downstream, and then hopefully scaling out into that if you like, that connected customer network. So all of this stuff's like really coming to life now, and we're starting to move with some really pleasing velocity and results. Next slide, please. Which kind of leads into what's been happening for us. So if we look at the past couple of years, we've had extremely modest growth revenues going back a couple of years when we sort of hit that transformation point, and then we started to grow. We've had, I think, 10 quarters of consistent growth, and those consistent growth quarters, most pleasingly, have also involved us moving to a recurring income model. So if we look at our September quarterly, we announced 95% of our income was recurring in nature. We also announced at that time what we thought we'd get to in terms of capital out the door in our lending business. And I suppose all that was really about where did we think our ARR was going to get to. Now, if you consider the carpet court transaction and what's been announced, we're really talking about a 20 odd, if not 25% growth in that recurring income stream from the first component of that transaction. So we're really closing the gap between our income and our cost structure every month. And that we're probably, if we were looking at the cricket worm, we're right on track at midway through the year to achieve that goal of cash flow positive in this financial year. So that's a really pleasing thing from the organization's perspective. And obviously we're at reporting season time. So, shortly the market's going to be informed about what did our performance look like in the December quarter. And again, I believe we'll be positioning that continuing trajectory to close the gap. And I suppose what we feel is that the market is going to start to wake up to not just our potential, but our reality. Next slide, please. And I suppose we might need one more tap. There we go. I suppose what I'm referring to is it would be fair to say over the past, maybe say January 21 to now, we probably have never really been valued on pure fundamentals. And, we've been dragged up and down with market momentum, but we were very fortunate to put away a transaction that gave us the capital to be able to build this business and build on the vision. And I suppose while we've continued to grow, the market's not necessarily been particularly kind to us, but obviously we're seeing some resilience come back now into the share price. We would expect that we're putting enough information into the market now analysts are able to really look at our business from a fundamentals perspective and understand why we believe we're on the right trajectory and why organisations continue to want to work with us. And I suppose, I guess before I take some questions, I'll just sort of close with, you know, as we're focused on closing the gap, really, we've got some exciting stuff coming in terms of our tech releases in the near term around our wallet capability and the expansion of our AP product as an integrated internet banking service. And what that's really doing for us is allowing us to create very sticky income streams that allow us to upsell and derive value for our customers, as well as increase our income, which is you know, it's really exciting times, and it's very satisfying to see that is where we are at. So without further ado, I guess I'll take some questions.
Thanks, Adrian. The stock market can be a very unkind place sometimes. I suppose that one of the questions is in regards to margins. I kind of see this as a margin business, and that brings into the question of what are your source of funds for, you know, lending, for example. So can you kind of talk through, you recently announced the establishment of a 50 million debt warehouse in the second half of the year. How will that be kind of utilised and help drive your revenue?
Well, at the moment, so I think if you look at our revenue drivers to, you know, and the things which help us achieve our goals in terms of you know, crossing through the cash flow positive threshold, you know, we've announced our $50 million facility, and, you know, we're very laser focused in the near term. We're not really looking for new deals per se. We just need to roll out, and we'll hit that that sort of 50% utilization, you know, by the half year. And I think that's probably that's sort of objective one for us. One of the things that we're able to do with that bundling is probably move away from quoting rates where we're going, you know, we're 15% or whatever the number is. It doesn't really matter. I mean, obviously we've demonstrated a much higher yield on our book than that, through that sort of blurring of the lines. And I think, again, you know, our cost of funds is a fixed cost of funds. So we've been very fortunate there as well. We've not had any rate increases through this period of time, so that's been fantastic. But there's plenty. So look, we've got plenty of margin across the board. Same thing with our payments. You're probably looking consistently. You know, every dollar of flow, we're probably at a minimum trying to derive a 1% yield from, and that, you know, that's on a monthly basis.
And so the three parts of the business model are the kind of the SaaS, the subscription service, the payments, and the lending. How do you see these three kind of different segments evolving over the next year or so?
Well, we probably have always thought that the software would be a vending machine. We don't see it as being the big win, and it's a very important win. But if I give you an example, if we were to do a deal with a customer, and this is not, you know, special knowledge, and let's just say we said our integration software per customer was $100 a month, and we rolled that out to like a carpet court network. There's only a couple of grand in income there, but without the software, you cannot do the lending and payment transaction in an automated fashion. You're back to, it's how we break the competitive tension. So the software in and of itself is we'll call it the workhorse that's maybe underappreciated from a revenue perspective. So we probably always expect that to be the lowest contributor. However, the most critical element to enabling payments and lending. And we would always see them kind of roughly running the same sort of race. Because if you think about a lend, every time you do a lend, you've got two payments anyway, one to advance the funds and one to get them back. So those ecosystems are constantly working with one another. We've got sort of two loan management stacks in our Spenda lending services, and then the Spenda payment services and lending services are constantly interacting. So they feed off one another. We would always expect them to be roughly the same amount of revenue. There's deals where, you know, there's more payment and less lending. There's deals where there's more lending and less payment. It's part of the reason why we started talking about sort of total flow through the platform, because that dynamic can change. But importantly, we don't care if how you're moving the money through the platform. We're going to monetize it one way or the other.
And Adrian, you got some fanatical shareholders. I've taken a screenshot here out of Twitter, and it was a list of things to ask. And one of them is in regards to kind of some of the franchise buying groups that you're targeting in particular. Could you address that if you may?
Yeah, I mean, look, we've made it really clear that for some time now that our strategy was node spoke. So node being the guy in the middle, the spokes being the people that they trade with, or in the case of Carpet Court national office is the node and the stores are the spokes. There's no question that we're chasing down other opportunities in that same space. There's also no question that we're also delivering other franchise groups at differing scale. And I think the thing to understand for us is the changing nature of material. So the faster we accelerate revenue, the less we're going to talk about the opening of every envelope. Obviously, Carpet Court was a significant achievement, and we're extremely thankful for that win. But look, we'd expect that the market would be informed of any material buying group or franchise group announcement, and we certainly are working with a few.
And I've just got this kind of list here. It's kind of eBev, Fresh Supply Company, Grain Corp, James Tyler. Are they the sort of names that, as I said, you've got some fanatical shareholders, so they don't miss a trick? Are they the sort of groups you're still in discussions with? And is there any update on those sort of deals?
Yeah, look, I mean, those names all sound pretty familiar to me. I think that the key thing is some of those. Yeah, I mean that when you've got a customer and it's steady state, the materiality of those things sort of fades to black. So we'd probably only be looking at updating the market if there was a material change. So if we were to lose a big customer, but we're not anticipating that. But those names are, sound like some of the people we are working with, but there's certainly, there's deals that aren't on that list that are between us and our customer. And as I said before, our pipeline is just about delivering into. So to hit our revenue goals, to hit the goals that we want, we just need to deliver. So and we would hope to be sort of halfway done with Carpet Court by the end of Feb. And part of that from the business perspective is balancing our own internal capacity. So a lot of the things that we're looking at is how do we do this over time, such that we can implement effectively and meet the customer's needs concurrently with our own internal capabilities. Because as a growing organisation, you tend to have a core of expertise, and you've got to spread that knowledge and be willing to let people make mistakes, learn and hope they learn from them, and learn quickly. So we're probably past the fail fast mentality now and more into the execute fast and get better and better at that.
And Adrian, just a final question. Overseas markets, is that a bit of a step too far at the moment, given your focus here in Australia?
Oh, maybe not. Look, there's no secret we've got a structure in India and a structure in Singapore. That's old news. It's important to understand that there's licensing obligations in different markets, and standing those up is very important. It would be fair to say that we've probably for 18 months now articulated our strategy would be to follow exported goods abroad and look at how we can participate in those transactions. And that's certainly what, the James Tyler question you alluded to, that's what that was about. And we've done a few things in that space to learn the game and perfect the craft and develop the product that we think can scale. And so I don't think our near-term focus is to try and stand up businesses in 55 countries. Our near-term focus is just about achieving that principal objective of going through the cash flow positive horizon. On the back of that, we obviously want to have scaled out systems that will allow us to take on bigger markets. We want to have a much tighter tempo and even the right, I'll say, execution flow for how we AML KYC, meet AUSTRAC compliance. There's a lot more moving parts of this thing than to go outside of Australia than maybe might meet the eye. But it's certainly on the 23 plan, but not not next week. How about that?
Understood. Adrian, that's all we have time for. I hope 2023 is good to Spenda, and we'll catch up with you later in the year. Thanks for your time. Have a nice weekend.
Thanks, guys. Thank you.
All right.